Hey everyone, welcome to a new episode of In the Money with Amber Kanwar. Today on the show, we've got Ryan Bushell of Newhaven Asset Management. And he's kind of interesting. He's of a younger generation, but he's not chasing these big growth names. I kind of called him an old soul in the podcast because he's looking for these ideas that can last for 30 or 40 years. And he goes after some of the names in pro picks that are, the markets are at record highs. But the names that he's selected maybe haven't participated as much in the rally. And so that's where the opportunity could be. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. Before we get started, a message from our sponsor, Raymond James Limited. For 25 years, Raymond James has been helping Canadians achieve their financial goals with confidence. As Canada's largest independent financial services firm, they manage over $95 billion in assets and support more than 520 advisors nationwide. What sets Raymond James apart is their commitment to independence. With no proprietary product to promote, their advisors are free to focus solely on what's best for each client, whether that's planning for retirement, funding a child's education, or preserving wealth for future generations. To learn more about how Raymond James can help you live a life well planned, visit raymondjames.ca. Ryan Bushell, thank you so much for joining me on the podcast.
I'm excited to be here, Amber. Thanks for having me.
I've had the chance to interview a bunch of times, so I kind of already know your style. And I think a lot of people who follow you or followed us on BNN probably get a flavor of it. But I'd love for you to just kind of lay out, now that we have the time on the podcast, like what is the style? You're not chasing high valuation stocks.
Yeah, it's really comes down to the people I work for. And I try to mention that as often as I can without being too promotional about our own firm. But what really I care about is those clients and their livelihoods and their ability to withstand whatever might come. And if you think about someone who's retired or retiring, we're still talking about decades into their futures. And typically that money, for my clients anyways, who are not spendthrifts and are not going through all their money, it extends to their children and their generation. So we always have to have a lot of longevity to everything we purchase. And if you're thinking about any sort of investment compounding vehicle, the best ones are the ones that can compound the longest. The easiest way to do it is to have something that's really sustainable and just be along for that ride, so to speak. And that makes it sound kind of passive and easy. But especially in today's kind of fast-moving world, it gets harder sometimes.
Is it too simplistic to call it kind of value-oriented income seeking?
I never have put a label on it. Like the interesting thing, the firm I joined that I started off with that kind of shaped my whole outlook on investments, because I didn't grow up in the investment world. Like my parents both had defined benefit pensions. They worked for the government. There wasn't like a stock portfolio conversation at our dinner table ever. They were hardworking and they saved money and they taught me budgeting and being careful with money and all of that. But the investment side was absent. So the firm I joined was started in 1939, and the principal, George Fraser, who I worked for, joined his father's firm in 1947, and he was kind of my mentor. And he existed before all these style boxes came to be, right? He basically just said, I've made 65 years worth of mistakes. Here's what I know. I can't give you like a set of instructions, but I can give you kind of a set of signposts to let you know if you're on the right track. And so I would like to call it sustainable investing, but that has been changed in terms of the meaning of that. But what we're really just looking for is companies that can last a long time. The income is a signal that your investment is producing for you. It is not necessarily the main focus. It's not just about the income. It's what the income kind of means.
The people listening probably can't see how young you look. And the reason I'm bringing it up is because I feel like the way you talk about investments, like we've had guests on who are, 70 plus. And so they talk the way you do because they lived through it and their parents lived through it. And then like I see a trend, there's younger portfolio managers, you have young kids, and, they're not really thinking about the retirees. They're thinking about chasing that growth. They like and they live tech. So how do you, are you just an old soul? Or why isn't that your investment philosophy? Because actually you should have been raised by investors who are more that vintage.
Yeah. So I kind of, like I said, I existed kind of in a vacuum almost, so to speak. Like I came in with no preconceptions, no idea. When I grew up, I sort of thought the stock market was a place rich people gambled, and that's where fortunes were won and lost. And you watch the movies, Wall Street, and it was like it wasn't a reality for me. And then when I went to Leon Fraser, the vintage of the portfolio managers there were older, 70s, 80s. And so I, as a new person, a naive person, just kind of went in there and said, these guys have lived a long time through this. This is not an easy business. Once I kind of got a better grasp on it, this is not an easy business to survive in. And George, he had back in the days of screensavers, you remember screensavers with the text that went across? On his screen, it said, there are old pilots and bold pilots, but there are no old, bold pilots. And so that always kind of stuck with me of like, yeah, you can chase things and you might be right for a period of time, but that one crash can kill you.
That's a good point. And I want to just underline that because what year was it that you got into the investment industry?
2006.
Okay. So then immediately you kind of see things go bad with the financial crisis. But since then, it's been pretty much good times. And so for some people like me, I only became a financial journalist kind of just as the financial crisis was deepening, but we were coming out. So I've really only covered bull markets. Right. Obviously some accidents, but generally stocks have always gone up in my career.
Yeah. And having that experience of 0809 was really formative for me as well, right? Because again, I was in a shop that had existed back to the Great Depression in terms of, George grew up in the Great Depression. And so it was, he was determined and they were determined kind of never to go back to that place, and that their clients would never have to go back to a vulnerable place.
It's one thing to have that as your investment philosophy, but you're not just a portfolio manager. You're the CEO of Newhaven and the founder. Talk to me about how old the company is and what prompted you to go out and do this. Again, you think about young bucks in finance. They say, well, I'm going to go out there and I'm going to do these super fun, creative, chase all these next big ideas.
Yeah. So I'm not the founder actually. So my partner, Stephen Moore, sort of purchased the firm. Okay. It was the registration, and he purchased it in 2006, actually the year that I would have started in the business. He had worked for BMO Nesbitt Burns for his whole career and was not ready to retire, but not really wanting to take on a full career, and sort of it was very not well known, just friends and family kind of a thing. And unfortunately, things at Leon Fraser, when George passed in 2013, started to change, and we were bought by a much larger company. And, that's the way things go sometimes. I won't get into all of that, but I wanted
That's what's happening in this country. All the independents eventually get swallowed up. Even Gluskin Sheff, most
Chef,
independent, Burgundy.
Yep.
Yeah, they all get swallowed by banks.
Well, because, it's tough because if you build something big, it's hard to pass it down to your employees. So what my partner, Steve, and I did was I came in, I purchased 15% of the portfolio, of the firm up front with money I didn't have, with borrowed money, and then earned my way up to be able to purchase now a majority stake. He still maintains a stake and is still heavily involved in the firm. And I enjoy his counsel. And going back to what you said about sort of investment philosophy, we joke often because I started during the modern depression. I won't be as... I'm not trying to be, glib about that. But the 0809 crisis was the worst since the Great Depression. And it was how much cash flow do you have? It wasn't how much growth do you have? It wasn't how many subscribers do you have? It was how much cash do you have on your balance sheet? Because we don't know if we're going to lend to you otherwise. That's how the crunch happened. And then coming out of that, we had obviously the run we've had. And the reason the run's been so extended was because that crunch was so bad. But with Steve, I joke all the time that he actually had the good times. I never really had them, and until more recently, and it's almost sort of very foreign to be in this environment now. I always thought back to when I was at Leon Fraser, like, how did they survive 2000? Like, that must have been crazy to be invested in infrastructure and boring stuff when everybody's making millions of dollars overnight, right? And we're kind of back in that world now. So going back to the firm, yeah. So he purchased the firm. I purchased a portion. Now I'm the majority owner. Never thought I would be an entrepreneur. Just always wanted to work in a company and do a good job and sort of be a good soldier kind of point of view. But it's fun to have the ability to shape something as you're finding out as well, I think.
It is a lot of fun if you just tuck away that crushing feeling that
the scared, the fear.
That it all hinges on you. But I like to keep that in a tiny little box. Let's talk about how this philosophy dovetails with the current market conditions. And it might be easy for me to assume that, you're going to be in the camp of this is all very bubblicious and multiples are too high. But when you said cash flows, like these companies that are spending actually do have the cash flows to do what they're saying they're going to do on AI. But what's your view of the current market?
On that specifically, I think, it will be interesting to see whether the thing about reinvesting cash flows is you need to keep reinvesting them profitably. And so the question will be on this AI build out is, yes, these companies have cash flows. If you're Google, AI is an existential threat to you, right? Like it can search the internet faster and synthesize more information than your search tool can. This is just my rudimentary understanding.
Yeah.
I'm not an expert in this. And so they need to be there. Obviously, the question is whether they're going to be a winner or not, and the money they're sinking into, the biggest part of the capex in I think it's a third or between a quarter and a third of all the capex in the S&P 500 is now being done by hyperscalers or the likes of the Mag 7 and their pals. So I have no idea whether it's bubbly or not. It seems like it historically. I'm a big student of history given my background. Any historical comparison you make on concentration, multiple, these circuitous transactions where NVIDIA is financing the people that are buying the chips, and then they're there's a lot of that going on. Like all of that is scary, and I don't mean that to be like so I can be haha I'm right one day. It's more just these are warning signs for the entire economy and the market because it's so material these days.
So that's interesting because I know that you like things like infrastructure and utilities, which are supposed to be boring and divorced from all of that. But there's no denying that they've also been swept up because how are you going to build that first wave? You're going to need infrastructure. You're going to need electricity. And so can you hold these two thoughts? Can you be bearish on maybe all the spend, but then still like the sector, like infrastructure and utilities?
Yeah. So here's how I'll square that for you. And it's not easy. But the way I look at it is that this capital is being spent there, and separate from the data center demand is this reindustrialization that's happening that's getting a lot less press now in terms of the power demand stack. But Torsten Slok, who is Apollo's strategist, you've probably seen his stuff because it's widely available, just put out a chart a couple weeks ago, and it was showing the amount of factory completions in the billions of dollars, and $32 billion worth of factory completions in the US in Q1. And this is up from effectively zero pre-pandemic and up 5x from where it was even 2 years ago. And there's apparently 500 billion of factory activity. Now, some of that is data centers, right? So it's not, but the point is that industrial investment in North America is hockey sticking to the upside. And so the question is how much of that's going to be profitable? I don't know, but those investments are going to require power. You don't build a $5 billion mega project factory and not turn it on. These are decades long investments. Like they're meant to last decades. They're not building it to last 3 years. The GPUs only last 2 or 3 years, but the bricks and mortar last longer than that. So there's going to be some uptick in power demand regardless. And that's what's exciting about our strategy these days, I think, is that, we would have been invested in infrastructure and utilities in the previous, had been in the previous environment where we were seeing kind of 1% load growth in North America. Now we're seeing 3 to 5. So, again, I don't know what you can make a big upside bull case. I just think there's a nice steady reinvestment, and that goes to kind of what's happening globally, which is a big thought as well. So,
but again, like a lot of these stocks have taken off, the market has taken off, but we've seen a little bit of wobbling recently in the last couple of weeks. We're seeing a wobbling today. We're filming on Wednesday. 1% drawdown in the context of things, that's fine. Maybe even a little bit healthy. But do you think you could see like tech-like volatility in utilities, in infrastructure, because of how far these things have run up?
I think there are certain pockets for sure. Like you saw what happened, like on the news, like the Capital Power and TransAlta are kind of good ones to watch because they've seen the most kind of volatility both ways, upside on announcements and potential of data center builds in Alberta, and then the big declines when that's been shown to either be a false start and I think eventually something will get done there. I mean, economically, it makes so much sense, right? I mean, the thing about data centers is they need excess power. So you've got excess energy in Alberta, and the cooler it is, the easier they are to maintain. Like building them in Texas is great because you can get stuff done from a regulatory perspective there, and they have the energy, but it's hot there. So it takes more energy to cool the facilities down, right? So there's but with what's going on geopolitically between Canada and the US, I don't think people can make that decision to sink several $billion into central Alberta. So who knows? But I think that the general utilities, like some of the ones in our portfolio, like a Fortis or an Emera, something like that, this is just general load growth within their regions that's going to extend for a long time. And they're not going crazy trying to satisfy it, but it provides a backing to their capital expenditure needs, which they automatically get compensated for through their rate base.
And we'll talk about that because you brought us some ideas. One of the other areas of the market that you might think somebody who is a little bit more defensive and liked capital preservation talk about more is gold. And do you guys have a big gold weight? That's never been an interesting sector for you. Is that right?
So again, I did buy some gold coming out of the pandemic. And what I always say, we own a Agnico Eagle, which is it's the large cap and been the best performer in Canada. So yay. But I always say I would rather not own gold. I'd rather have my money in productive resources. I am a believer in the Warren Buffett, if you melted down all the gold in the world, it would make a cube the size of a baseball diamond. And then what would you do with it kind of argument. But what's happening today is that the value of money is in question. The value of Western fiat currency, whether that's Japanese yen, euros, pound sterling, US dollars, Canadian dollars, Australian dollars, that's been put into question because we've gone to a free floating system that's not gold backed, that's not asset backed. And what the asset is now telling you is that the value of that currency, I always say it's not everybody focuses on the numerator, like stock prices go up, gold prices go up. Nobody's focusing on the denominator, is that they're valued in dollars. And so there's a two-sided thing happening here where yes, the value of assets is going up, but
how much it's worth to you is going down.
That's right. And so it becomes this, when you ask about how much could utility stocks go down in a crunch, well, we saw some very coordinated downturns in both 2008 and 2020, and those were systemic. And the market is so much more interconnected now, and with technology, things can be sold faster and quicker. And I won't even get into the market structure on ETFs and passive and how people know that, and so they step away during crisis, which actually makes the volatility worse. So what anything is worth is up for question today, and so gold. To me, it's like I would rather not have to own it because I would rather, and I think there's a lot of good things happening in the North American economy, and that's where we're most focused. But we had to add a weighting coming out of 2020, given the geopolitical changes we sort of saw afoot.
Do you think it's over, the gold rally? I mean,
I don't.
You don't, because we've seen a big pullback.
Yeah, I think there's going to be volatility. I read RBC had a note out this morning saying, they had a sort of 1 standard deviation, 2 standard deviation, 3 standard deviation correction, and that gets you down to kind of the 3,500 level, which would make people freak out. But that's only where we were in July, so that's totally reasonable. But I do think over time, until you see a credible thought process around how we are going to square budget deficits with declining demographics and a reindustrialization push that is, fiscally stimulative, but not good for government balance sheet in the US, and then extend that to the other G7 countries. Until we see something credible there, you're going to see, I think, gold, Bitcoin, stock prices reflecting that question on the denominator. And so how far that goes, I think, is anybody's guess.
Let's tie this in a bow before we go to the mailbag. What does positioning look like for you now? Are you raising cash? Are you fully invested?
Sitting on too much cash, especially now that rates are declining again. So when rates got up to 4 to 5%, we were kind of happy to sit on some cash given the froth in the market. Again, you said, I'm an old soul or I'm conservative because of my clients. I want to be able to look them in the face and put a credible portfolio in front of them that is sustainable over a long-term basis. And so I don't worry too much about 1 or 2 years of even having too much cash. This is decades, and we're trying to find good things that we can own. But when rates start to drop, it does push your thought process to, I can buy BCE with a 5 yield and it'll probably stick around, and, I'm probably not gonna get hurt too bad on the downside with it, and it's a better placeholder. But I'd rather find things that are exciting and sustainable and growing. And so with that I'm not overpaying for in a crash. So yeah, we've got too much cash right now. We're heavily invested in utilities and things related to power demand. That's over 50% of the portfolio. That's natural gas, that's utilities, that's other infrastructure investments, the energy, transportation, renewables, and construction. And from there, we're looking to complement that with a few businesses that we would hope that on some sort of market mean reversion, which we typically do get from time to time, we'd like to get more invested.
I'm going to pick up on that bait that you dangled in front of me around BCE. Are you adding to BCE for that dividend?
For anybody that doesn't have enough. But we're not adding weight to it. So clients, we've seen it come down a long way. So clients are at different weightings, and we always have cash coming in as well. It was interesting. I was talking to Nancy, our head of operations, this morning, and we were talking about just how much the firm has grown, and we just passed 400 million in assets, and that's not important. But what's important is every 15th of the month and every 30th of the month is when the dividend payments are concentrated. And now when they come in, we sum the lines and it's like 2,300 lines and it's $500,000. And the point is that money comes in, and some clients are using that to fund their lifestyles, but most don't. And so we need to reinvest that. And so that brings, if a stock does poorly, it goes down. And then if the cash weighting grows because of dividends, the weighting goes down further. So we're always having to kind of rebalance. I call it kind of cutting the grass. You're either taking out the ones that
So it's not a call. You might be buying it, but you're not. It's not like
but
a
we're
call.
Always buying. That's the thing, is we are always every quarter, and that's the discipline you have to have. You have to be invested, and that's the biggest problem people have had in the past 15 years is not being invested.
Let's go into the mailbag now. Okay, our first question, I want you to channel your colleague, Rebecca Telscher, for this one. It's on CNQ. Everyone seems to love CNQ, but it has been lagging. What do you think of the stock? This one coming from Paul. And Rebecca was on the podcast a few months ago, and boy, she really convinced me too. And someone on Twitter said, find yourself a man, find yourself a woman who talks about you the way Rebecca talks about CNQ. Like, that's how much she loves it.
It's so funny with Rebecca. So Rebecca and I have worked together. I hired Rebecca for her first investment job when we were at Leon Fraser. And so we've worked together a long time. And when I moved to Newhaven, I really wanted to make sure that I could bring her on board at some point. I'm so happy that's worked out. But on CNQ specifically, I convinced her on CNQ.
She's converted.
She was not a fan of oil stocks generally. And again, when your initial experiences are always the most formative, right? She comes in 2013 and oil gets tanks in 2014 and into 2015, and we see the tide go out on Calgary, the whole city, the tide goes out. But CNQ is one that has been left standing. And if you look at that company, as I said, I think it's one of the best managed companies in the world, any sector, any business. Their governance is outstanding. They're not trying to be flashy. All they care about is return on invested capital and doing a good job for their shareholders. And so I think, there's just been attention other places in the major oil space in Canada this year. IMO has been an outstanding performer.
Imperial Oil.
And then Suncor continues their turnaround. And then you had this Cenovus Meg deal with Strathcona. And so it's just kind of sucked some of the auction out. And they're becoming sort of more like Canadian banks in terms of there's 4 or 5 of them. Everybody knows who they are now. There's been so much consolidation. And so the money kind of moves from one to the other depending on what's going on.
So that's what people say. Like, it's nothing operational with CNQ. It's just like everyone who owns it.
Yep.
And there's no one else to own it.
Yeah, unless, and this is what's been interesting though, is that you got the commodity price sitting back at $57, $58, and the stocks have held up pretty darn well. And so as someone who's been like Lucy with the football with Canadian energy stocks, and will foreign investors ever come back to them? It seems like they are. And I read a very in-depth nat gas report that was sent to me by a colleague, Brian Tyke, who is a great guy. If you ever want to speak with him, he's taught me a lot. He's younger than me, but he's taught me a lot. That this natural gas story in North America is about to change. And CNQ is one of the largest natural gas producers in Canada, despite being the largest oil producer as well. And so I think it's a balance there. And I think you're just seeing that Canada is extremely discounted in terms of our energy investments because of all the policies and things that have happened over the past 10 years. But with a 70-cent Canadian dollar and long life reserves that don't have the same treadmill that now the shale treadmill in the US is starting to break down under its own weight. I don't know. We'll see. You can make a pretty bullish case, I think.
You mentioned the Meg Cenovus situation. We've interviewed Adam Waterous a couple of times on Strathcona. He's made his pitch. He's withdrawn his offer, which everybody thought was then a done deal for Cenovus to buy Meg. And then this week, Cenovus still doesn't have the votes, which is shocking because there's no other bidder. And Cenovus increased their offer, and Cenovus has been buying shares and voting those shares, presumably. Are you watching this as an investor? Are you invested in any of these companies? Like, do you have any insight into what could happen there?
We owned Cenovus a while ago, and when I moved to Newhaven, I slimmed down our energy portfolio, and I went with I want 3 companies that I can rely on, and it was ARC, CNQ, and Freehold Royalties. So smaller, medium, big, and these are the companies I want to own. I still like Cenovus. I think it's a good company. It's had its problems for sure. I was shocked when they bought Husky. I was like, why wouldn't they just buy Meg?
Well, they're trying.
But they kind of got forced into it. Strathcona kind of pushed them into it. I don't think they were really ready to go. So I find it interesting just as someone who's watched the space for a long time. The thing I heard yesterday that I thought was very interesting was that the mail strike might have impacted this, getting the proxies out.
Okay, yeah.
And I was like, I had the same reaction. I was like, oh yeah, that does kind of make sense.
It's very hard to vote a proxy. It's not a digital, a fully digital.
You're not paying attention to it, and there's a season they come in, and a lot of them come in, March, April, May, when all the annual meetings are. But in September, October, you're busy doing other things. You're like, oh yeah, there's this, I'm waiting for the proxy. When it comes, I'll vote it, but it's not at the top of your mind. So I who knows? They're only missing 3%. I think they will get it across the line, but it's fun to watch for sure.
It's fun to watch, yeah. And I don't know, maybe there'll be a third act, an interloper.
Yeah. Yeah, I mean, it's just been really that it's been a dry desert in terms of people coming to buy Canadian assets.
I know it really has. We're going to talk about some of those opportunities in Pro Picks, but let's shift a little bit. Given your style, we obviously have to talk about the Canadian banks, and we got a question about them. I mean, what economic slowdown? Because the Canadian banks are at record highs as an index.
Yeah, it is. It's surprising to me. So I've been but anytime I'm asked, I've always said I'm pretty cautious on the banks for the past couple of years. We've been underweight. Not so much because we don't like banks, but more because we really are convicted on this power theme. So that we had that money had to come from somewhere. And so
in the past, it's been different.
Yes. We used to have about a 20% weighting, which was still underweight, but closer. Now we're 15%.
It's not a call really on the sector.
It's not so, I just think, so big picture, looking forward, 30 or 40 years, which very few people do, but the last 30 years were great for the Canadian banks, right? Oligopoly, big real estate boom, consolidation, insurance, brokerages, all got rolled into these Canadian banks. And now it's kind of like, what do they have left? They have cost cutting, technology, and international US kind of expansion. So that's fine. And it still warrants a place in our portfolio. And we still like the oligopoly, and we still think that they're well run, and we like the dividend, and we think there'll still be growth there. But does it warrant an overweight position in a sector that's already pretty heavily weighted in the index? So that's kind of our thought process. And in the near term, I keep looking at the Canadian mortgage renewal window is coming up in the next, 6 to 12 months.
I know, but everybody knows that, right?
I know everybody knows that.
Everyone knows that. The borrowers know it. The lenders know it. They're on the phone. They're calling. They're look at the accounts.
But you're also seeing a declining employment picture heading into that. And that's the part that worries me, is that it's the combination of those two things. And so, and it's not even people losing their jobs, although, again, just today, a close contact of mine, their company's laying off 8% of their workforce just today. So that is happening. But it's people being less employed, bonuses going down. And so for some things like mortgages, it's you get this renewal, and then all of a sudden you get it, and you actually have to start paying it. So again, I'm not saying that it's going to be a calamity, but I don't think it warrants record high valuations either. So we're cautious. We're holding. We haven't added we bought a lot of TD on the downturn the last couple of years, only because it was a big holding. And like I said with BC earlier, like it got underweight, and we were kind of just forced to add to it. And thankfully we did. But yeah, I think, we had a very similar picture on the Canadian banks coming out of 2022 into 2022. It was like rates are going up, but not so much that it's going to hurt people, and there's going to be economic expansion, and the banks all ran, and then they all came off hard in the second half of 22. I think you could see a similar setup into next year. But we'll see. I mean, we don't really care so much. I'd love to buy some more at better prices, but I'm not willing to buy them here.
Well, let's see if we can find opportunities at better prices for Thomson Reuters. Everybody knows I'm a sucker for these underperforming stocks. And Thomson Reuters plunged this summer. And I did see, actually, I think when they plunged, it was after earnings, a bunch of upgrades. And then the stock plunged even more. And so right now it's coming off. I'm just looking on the chart, but it got down to like the lowest level in more than a year, maybe almost since the beginning of 2024. Let's backstory this a little bit. Why it went from an all-time high, and then after earnings fell off a cliff.
Yeah, I don't follow. I used to cover Thomson Reuters like back in my early days in the 2013, 14 period. And it was another one that was so frustrating. It would get up to 35 and it would come back. And then finally it ran to 70, and I sold it. Some other people in my firm who have been with, that I worked with previously that have come back, they kept it and have done very well on it. I did put the money into something that did well, which was Enercare, which then got bought by Brookfield Infrastructure. So I'm happy.
You were able to lick your wounds effectively.
But it is kind of like the one that was like, I was right on this thing, and I didn't let it be right. So it's a learning experience, and your life is filled with them. Especially in this business, it's a humbling trade. But my view of Thomson Reuters now is like it got sort of into this whole AI tech trade. It's a big cap name in Canada. It's one of the only kind of Canadian names you could own in that space. They were having success. Plus, it saw this kind of passive or thematic, run. And then
it's like business. It's like essentially now business software.
Yeah, but now look at look at Netflix today, right? Like they didn't even miss, and the stock got hit by. So the expectations are so high for these companies that and there's something else. There's a new shiny object every day, especially with how rapidly technology is evolving right now, and how many new companies are either coming to market or having funding rounds, or something like CoreWeave comes. It's like the money has to come from somewhere, right? And so I I don't think it's anything more than that.
Just a victim of high valuation.
I think it's a consolidation period, but I don't think it's cheap enough that I want to run out and buy some right now.
Okay, interesting. We've got a question on, this is smaller cap, maybe not as household, KBL.TO Linen. This one coming from Noel in Edmonton. Maybe let's start with what KBL.TO is.
Yeah, so they do laundry. So they are an industrial launderer of, high volume things like hospitals, hotels, tablecloths, scrubs, bedding, things like that. And they'll also lease or linens to you as well. So this is a company it is a smaller company. We own it, have owned it for some time. It's been okay. But what I really like about it today is the business is very defendable. It's not expensive, 3% and a bit yield, a really good management team. It's run by Linda McCurdy and the CFO, I can't remember her name.
I'll find out.
But they're not flat. Again, it's sort of like
Flatquin.
Yeah, that's right.
Yeah.
They're not flashy. They're not on the street doing deals. They're not, they don't have a lot of research coverage because they're not doing a lot of deals. They just recently did an acquisition in the UK, which again, the UK, I go, that economy, but it's a consolidation opportunity for them. They're already there and they're pretty excited about it. So I trust their judgment on that. And, someday I think you'll wake up and this company will either be acquired because it is an ideal private equity business, recurring revenues, but I hope it doesn't get acquired because I want to own it, but that could happen. Or they just keep growing steadily. They've invested in capacity ahead of time. So they've invested in bigger, more efficient laundry machines that then they can put more throughput through and all they need to do is sort of get more clients. And as hospital budgets get cut, sometimes they have internal laundry operations that then they move to outsource and just the general growth of the economy. So yeah, we'd like it. It's not super exciting, but
that's what I was going to say. So the revenue is growing. It had a big surge this summer because revenue surged to a record. So obviously they're doing well, they're profitable, and they've got cash flow. But you are looking at a Canadian $500 million laundry company at a time where we don't want to talk, I want to talk about Beyond Meat is surging 100% today. But talk to me about how patient you have to be with these kind of names.
Honestly, so that goes to our strategy and our philosophy, right? Like this is actually an ideal name for us, and I'll tell you why, is that I have clients that are going to be with me a long time, but I also have new clients coming in steadily all the time as well. And so the best stock for any compounding and reinvestment strategy is one that actually goes down, but let's just say stays flat for 30 years and then hockey sticks up because you're constantly reinvesting those dividends at a flat share price. And then you want all your share price appreciation later on, if ideally in a perfect world, right? What we'd really like to see is just a straight line of performance, but we know markets don't go in a straight line. So a business like this that kind of sits off the radar, that we know is a good business, a good underlying business, and eventually it'll have its day, is a perfect investment for us because it fits our we have to be right on the value of the business, but we don't really care when we get that value. The further out in the future we get it, actually, the easier it is to compound it. So that's why we like it. Not just that, we like the underlying business first and foremost in the management team, but I don't mind that. It doesn't bother me.
Still need laundry, I think, in AI, right?
That's right. There's no AI I don't think is going to take stains out of tablecloths.
Let's round out the mailbag. You mentioned this stock that you own and you like, Fortis. Johnny's got a question. It's a long-term in his RRSP. Any thoughts on the company moving forward? It's trading at a record. There's a stock. You were looking for one that goes up into the right.
Yeah.
It's Fortis. It's been a beautiful stock. It also pays a dividend. I guess what has been the story that carries it?
So this is, there are formative experiences, as I mentioned earlier. Fortis was like the Leon Fraser stock, right? It's Canada's longest track record of dividend increases. And I keep saying Leon Fraser, it's now a Newhaven stock.
It's good to remember where you came from.
Yeah. I think it's almost 50. It might be 50 years this year, actually. I think they're scheduled for a dividend increase any day now. And I think this might be the 50th year. If not, it was last year. It's right around 50, give or take. And so this, to me, again, is a business we buy almost at any price. I mean, obviously, we like to get it cheaper, but you've got almost an infinite runway in terms of there's going to need to be a utility in the jurisdictions that they operate in. There's going to be a utility that satisfies that. If you have one that's well run and is focused on shareholder returns, that's exactly what you want to see. And they will steadily grow the dividend, and the share price has to follow the dividend over time if that dividend growth is sustainable, right? So you're not going to it's not going to yield 4, 5, 6, 7, 8, 9, 10 as they increase the dividend. Eventually the share price has to follow along that if that increase is going to keep going. And when you get 50 years, eventually that share price follows along. So,
but the business has changed over that time. It's not just a Canadian utility. It's got big exposure to the U.S.
Changed a lot. And what's interesting is, so we got to know the company pretty well. And then because we were big and early investors in the company at my previous firm at Leon Fraser, they would come in and see us like into our boardroom. And so I got to know Stan Marshall and Barry Perry and now the new CEO as well, who's the guy from Arizona. I think his name is
David. Yeah, David Hutchins.
And so what struck us about that company is, one, the culture. And I remember in sort of 2010 through 13, they were doing all these deals in the US, and they bought Central Hudson in New York, and they bought UNS in Arizona, and then they eventually bought ITC. That was posted. But I remember I was speaking to Barry and one of their other executives. I said, "You guys must be busy. Like, you must have every investment banker in New York now call." He's like, "Yeah, there's a line at the hotel in St. John's, and they have their Newfoundland accent," and it was so great. And I said, "So are you just going to keep doing it?" I said, "No, this is just an opportunity that's right now, and we're taking advantage of it." And you know what? They haven't done one since.
So you like that discipline? They're not growth by acquisition at any time.
They saw an opportunity, and what an opportunity it was. You had the U.S. market, two separate major downturns, the 2000 downturn and the 2008 downturn, took the S&P. People talk about, you have to buy U.S. stocks now. Where were those people in 2010 when that was actually the time to buy U.S. stocks? Now everybody's caught religion again. But the Canadian dollar went to 113 against the U.S. dollar. They had it was in retrospect a slam dunk, and good on them for capitalizing, and a number of other Canadian companies as well: TC, Enbridge, AltaGas, TD Bank. A number of companies capitalized on that, and that's where when people say, "Oh, you're a Canadian investor," it's like, well, my Canadian companies have done a pretty good job of purchasing some U.S. assets at times that were advantageous. I don't know if I'd be purchasing the same ones now.
I'd love that a mental image of these Wall Street bankers in Newfoundland lining up to say,
there's one hotel.
Yeah. Right, okay, well, let's get into some of your best ideas now. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. All right, your first idea. I mean, I have a lot of questions on this one, but give me the pitch. The first one is Pembina Pipeline. What's your view on it? Why do you like it here?
So really like Canadian natural gas, first and foremost. It's underpriced relative to the rest of the world. It's, we've had transportation bottlenecks, which are now easing. We're getting, LNG Canada plus a couple of other facilities, one of which Pembina is building, the first floating LNG facility alongside the First Nation, the Hassla First Nation, I believe. And so they're touching a lot of gas in Western Canada, and those volumes are going up. And we said this during the oil price downturn in 2014-15, when people were really critical of our investment strategy. And we said, we own some producers and they'll be fine on a long-term basis. But what we're concerned about is the amount of volume that is growing in North America. And that's why prices are down. And we own the companies that are handling that volume. So it's this exact same story on Pembina, that volumes are going up. They deal in volume, tolls on processing, tolls on pipeline commitments, and now a pretty vertically integrated structure with some LPG export, and eventually LNG export. And then there's this data center news as well, which they may or may not be a part of. So that's kind of an upside case. But
before you expand on that, I want to ask, with all of this good stuff, why has the stock underperformed all the other pipelines?
So 2 reasons, I think. So the first is that, well, actually, there's always a number of reasons. One thing I would say is that money started to flow into Canada and it went to the large cap names. So it went to Enbridge and Trapp. And that makes sense, right? They're easy to buy. They're in the index. And then you get the passive reinforcement cycle of, okay, hey, a bunch of, if you're in the US and you're a hundreds of billions of dollar money manager, like even a Pembina is pretty small. You need the liquidity. So there was a bit of a virtuous cycle there. And then, it gets bigger in the index, then the index has to buy. And so there's a passive reinforcement cycle. So that's one thing. Second thing is their growth is a little further afield. And I think people are concerned about the floating LNG project, which we are not concerned about. I think it's actually
concerned how in terms of expense?
It'll go over budget. Okay, it'll be late. We saw all the overruns with LNG Canada and Coastal GasLink. But like in this case, it's actually their costs are pretty controlled because of the way it's manufactured in Korea. It gets floated over, it gets assembled. So we're not as concerned about that. And then the third thing more recently is you saw the announcement on the data center pushed Pembina back up to 58. And then it came off again when KKR started talking about shopping their stake. So sorry.
I was going to say, so there was, just to put some context around it, in the beginning of October, the Logic reports that Pembina could be working maybe with Meta. So that's totally still unconfirmed. Okay, then KKR.
But Pembina confirmed that there's something going on.
There's something going on, yes.
The counterparty. And I think if they had said, yes, we're working with Meta, everything, it might have gone higher. Who knows? But again, this data center thing in Alberta, as I said, it's been a number of false starts. So I think the market is very attuned of there's these short-term bumps, but until we see something concrete, then they'll take it right back away.
This is for something called the Green Light.
Energy complex.
Yeah, Green Light Energy Complex. And that's what Meta would be.
Yeah, so basically they're I don't even fully understand it, so I won't speak out of turn too much, but basically building a large data center complex. In this natural gas report I read, it went over some of the Meta and OpenAI data centers that they're building in the States, and these things are huge. Like it's like 2 acres by 1 acre, just the facility, and let alone the surrounding land. So Alberta has land, Alberta has energy. It makes sense to build a data center there. We've talked about that. The question is political more than anything about, are we going to have capital that's stranded? Is Trump going to like Meta building a data center in Canada? Does he want those dollars to be
What's
spent?
What's it going to do for local electricity prices?
All these considerations. So that is not something we're banking on, but we would not be surprised, because Pembina has been very proactive in their history of getting things done, to see them involved. And I think people were surprised to see them at the top of the list versus a Capital Power or a TransAlta, but they also ran.
So it's a cherry on top, but not part of your thesis.
Exactly. And then, so they have this JV with KKR, Kohler Kravitz Robbins, the big private equity firm that they've been building, joint venturing on gas projects so that Pembina doesn't have to fund these things all by themselves. Remember that, sorry, I'm not trying to be paternalistic or whatever, but you have to remember that in the last decade, all these Canadian companies were strapped for capital. Nobody would back them, right? So they found creative ways. They're like, well, private equity, guess where there's a bunch of capital, U.S. private equity, and they saw the returns, but the general market would not fund a Pembina equity issue, say. So they found this creative end around with KKR, and it's been a great thing for them, and it's been happening under the surface. And now this thing has grown to the fact that KKR stake, I think they said, is around $5 billion. And then I just read in the Nat Gas report that I've referenced a couple times, that KKR is buying into a JV with Sempra for $5 billion. So it's like they're rotating maybe out of Canada. And that's what private equity firms do. But now Pembina is seen as the logical buyer of that stake. So an equity issue. So there's an overhang. But I don't think it would be a bad thing if they bought it. It's just a question of the fact that I think their equity is undervalued, and so it wouldn't be as accretive at these prices as we would like.
So maybe wait for the equity issue, or you don't care.
I don't care. I buy it today.
You buy it today.
I think it's, again, on a long-term basis, it's one of the few things that's not pricey.
It's clear you like natural gas, which brings us to our second idea, which is ARC Resources. And you don't shy away from underperformers, which is what ARC Resources has been. So talk to me about why it has underperformed. Even though it's a difficult tape, it is still underperformed. And what you see is the re-rate potential.
So it's underperformed this year, I would say, and that's what we're talking about, and I get that. But actually, over the past 3 or 4 years, it was a tremendous outperformer in the space, and just generally. So yeah, again, I really, Charlie Brown with the football. I use that analogy a lot of like I really try to not get too wrapped up in my own thesis. And especially when it comes to commodity prices. But natural gas is poised to move higher from here. Structurally, I think LNG Canada puts a floor under natural gas prices, which will be very nice to see for Canadian producers that have not had a floor whatsoever for the past 10 years. It's been a bottomless pit. Prices can go negative. And so that'll be good. But then there is the case that if US at $57 crude, they're not going to drill as many crude wells, that treadmill starts to slow down. The associated gas that is coming from those crude wells starts to slow down. And there's just actually less gas in the North American system at a time where LNG facility build-outs in the US is poised to double in the next 5 years. So we're using, and that's before we talk about data centers sucking gas for power behind the meter and all the other things that are going on. So I think there's a lot of natural gas in North America was so cheap for so long that we've now built a wall of demand that is coming that is going to push prices higher. And that demand is coming from internationally via LNG. It is coming from domestically via power demand, and even just general, expansion of the general natural gas network for residential. So I am positive on that whole theme, and Canada isn't directly in that, but we've got our own dynamics going on where we're getting egress for the first time. Our prices have been lower. There's kind of like a lower bar to clear. And ARC, to me, again, it's liquid rich. So there's a lot of propane and butane and ethane in their gas, and that's what they've been priced on. But actually the gas strip side of it, I think, starts to look more exciting. And so I like it here going forward.
Were there some operational issues? That there's concerns with their Attachie natural gas play?
Yeah.
Phase 1 was doing really well, then not doing so well, and now there's questions about how much are they going to spend for phase 2.
Yeah, and I'm not a geologist, but it's about produced water coming out of the wells, and this is an issue of shale, right? It's a well-known thing in the market, but it's still a novel technological, geological advancement that people are learning about and improving every day. And so I think they'll get through it. They have a really qualified operations team, and I think they know the market's keenly focused on it, and I think they'll get through it, and that therein lies the opportunity. So you mentioned I like underperformers. Yes, in this market there aren't very many of them, and you got to buy the quality businesses that have underperformed, that have the chance to perform in the future, and that's what we're all about.
And you said you don't mind a sideways business, if at the end it goes up.
As long as the value is that's exactly right. As long as the business is of quality, time plus quality equals results. Sometimes it's more time than you want, but we tend to try to take our time. So we're happy with that.
And is that what you think is going to happen? Your third pick is Brookfield Infrastructure. Another, I guess you could call it a sideways trader. Like it lives kind of tends to tap out at around $35 US per share. I'm looking at the US quote here. There's some volatility in there. But what's your thesis on Brookfield Infrastructure, and where are you optimistic?
So we like the underlying business, just because you've got Brookfield there sourcing opportunities globally, and they are a private equity player, so they're buying and selling things, but generally they're good portfolio managers. There is an angle of they own Interpipeline, and they bought Enbridge's natural gas gathering assets in Western Canada, so they've got a big position in a theme in a place that we like, that we think is undervalued. But they also bought Enercare, which I mentioned earlier. We like that business as well. So there's a bunch of things in Brookfield Infrastructure we like. We mostly like the 5% plus yield or the 4.84. I think I checked it this morning on the units. And that's where I see an opportunity right now, is that there is some scrutiny on the unit structure versus the corp structure. The corporation, Brookfield Infrastructure Corporation, is just a company that holds the units. Okay. So, and that was created because institutional investors couldn't hold the units. It's a Bermuda limited partnership, only Canadian listed for tax purposes. But the taxable units that the corporate structure that was created has now blown out versus the underlying partnership units. So basically, you've got the same security. One's trading at a 35% discount to the other. So for me, I go, and typically what's happened in the past has been the institutional investing community kind of loves and leaves the
Okay, so there's BIP.UN, which is the units, and then there's BIPC, which is the
corp structure.
And you're saying by the
units.
BIP.UN.
Yeah, and especially as a Canadian in a registered account, because then you don't have to worry about the problem with the units is you get this horrible T3 at the end of the year that your distribution is made up of so much U.S. interest and U.S. dividend, Canadian dividend, return of cap, and it's just, and you have to wait for it. And so individual clients like we deal with don't really like that. But so what we do is we just put it all in their registered side. We treat their entirety of their accounts as one account, but we put it all on the registered side. And then you're basically buying it at such a big discount. Now, the question is whether they'll harmonize this structure at some point and either take out the units.
It's the same thing.
It's the same thing. And I mean, Brookfield's not afraid to use complicated structures and keep them and say, you guys deal with it if you want to own it. We've got lots of other people that do if you don't. So we're happy either way. But I do think there's the spread on both the partnership units for the spread's even wider on renewables now, which is interesting as well because Brookfield Renewables, because that space has seen some attention this year, right? And especially from the institutional community, but the retail community, which owns the units, is kind of sleepier and not really as willing to push the price one way or the other. So yeah, we think it's not necessarily a free lunch, but it's a nice downside protection in a name that we like.
Ryan, thank you so much for joining us and bringing these ideas to us.
It was a great time. I hope to do it again.
That's Ryan Bushell joining us from Newhaven. Make sure you tune into our next episode. We're going to speak with Rob Lozon of Middlefield. He does a lot in energy stocks, but that's not the only thing he does. He also focuses on income-oriented stocks, North American large caps, things like that. You can send us your questions. Email us at questions@inthemoneypod.com, and we'll see you on the next episode.